For 4 years, the loudest conviction in crypto was 3 words: never sell Bitcoin. This week, the company built on that creed sold its first Bitcoin sales since 2022, only 32 coins, but the signal dwarfs the size. Because its entire stack, 843,000 Bitcoin, now sits below what it paid. The coins pay nothing. The dividends still come due. That is the textbook definition of a forced seller. And while the leveraged version of hard money cracks, the hard asset itself just took the crown. Gold has overtaken treasuries as the world's top reserve asset. So where's the edge? Own the asset, not the lever on it. The evidence, not the noise. This is the Asymmetric, Issue 5, The Unwind, Tech and Crypto Investing for Thoughtful Retail, written from an operator's lens. Last issue read the tell, the wave of mega-issuance. This issue watches the first thing break. The one-line read: Strategy sold Bitcoin for the first time since 2022, only 32 coins, to fund a preferred stock dividend. The size was trivial, the signal is not. Its entire 843,000 coins stack now sits below cost. The coins pay nothing, and the dividends still come due. Bitcoin fell under $67,000 into record fund outflows, and underneath it, a quieter fact: gold has overtaken treasuries as the world's #1 central bank reserve asset. You'll see the same labels throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime and the 2 new facts that moved it. The regime at a glance. The Federal Reserve is on hold, between 3.5% and 3.75%, with a hike whisper rather than a cut. The 10-year Treasury yields about 4.5%. Gold sits near $4,500 and is now the #1 reserve asset. The S&P just printed its 24th record high of the year, near 7,600. Bitcoin is below 67,000. The index makes new highs while the most leveraged risk vehicles get liquidated. That coexistence is the late cycle tell. The structural headline: gold has overtaken treasuries as the largest single asset in global central bank reserves, about 27% of official reserves at the end of last year versus 22% for treasuries, according to the European Central Bank. The driver is a multi-year price rally plus sustained official buying from China, India, Poland, and Turkey. De-dollarization is no longer a fringe thesis, it's a measured allocation. That's a structural bid under gold and a slow erosion of the Treasury and dollar reserve premium. Rates and the Fed. The funds rate has held since the late April meeting, and the easing bias is gone. The market is no longer pricing imminent cuts, and a slice is positioned for a hike. The new chair, Kevin Warsh, had argued for lower rates, yet the tape still carries hike odds. Higher for longer is the base case, not a risk. A fresh input: trade policy. The administration proposed new tariffs on around 60 trading partners after forced labor investigations, about 12.5% on most, including China, Japan, South Korea, and Brazil, and 10% on 16 others, including the United Kingdom, Canada, Mexico, and the European Union. It's still in a comment period, but it's a fresh sticky inflation input that reinforces the no-cut regime. For now, equities are shrugging it off. Geopolitics and oil. West Texas crude is near $89, Brent near 92, off about 20% from the year's peak on ceasefire optimism, even as strikes continued. The Strait of Hormuz, roughly a fifth of global energy flow, remains largely disrupted. The consensus is positioned for de-escalation. The variant is that thin spare capacity makes a real disruption a fat tail, while a signed deal gaps oil down. Genuinely two-way. Put the macro together: sticky inflation with no cut coming, a fresh tariff input, the index at record concentration, a live oil tail, plus 2 genuinely new facts. Gold formally took the reserve crown, while the financialized version of hard money, leveraged Bitcoin treasuries, is the link now breaking. The read: own the asset, not the lever on the asset, and keep dry powder for the volatility the tape isn't pricing. Part 2 in focus: the forced seller, the data, the mechanism, and the debate. Strategy holds 843,706 Bitcoin at an average cost of $75,000, $699, that's straight from its filing. With Bitcoin near 66,600 today, the entire treasury sits below cost, roughly a $7 to $8 billion unrealized loss. It sold 32 coins for $2.5 million to fund a preferred dividend, its first sale since 2022. The premium that once minted cheap equity has collapsed toward 1x net asset value. The issuance engine has stalled. Assets that pay nothing, liabilities that pay cash, and a funding window only open at a premium. That is a forced seller in slow motion. The debate, the bull case, 32 coins is a rounding error, about 0.004% of the stack. Tom Lee called it classic bottom behavior, and the company still has a $21 billion equity shelf. A Bitcoin rebound restores the flywheel instantly. The bear case, the signal dwarfs the size. A company whose identity was never sold to pay a dividend, with its coins underwater and its issuance engine stalled. The reverse flywheel has turned. This is a research view, not a call to short. The point is what to own around it. The asset, not the lever. The liquidation tape. Bitcoin fell about 6% on the day to near 66,600. Ethereum slipped below $2,000. Spot Bitcoin funds have seen record outflows, roughly $3 billion over 10 or 11 straight sessions, the largest redemption streak since they launched. About $1.8 billion of leverage was liquidated in a single day, most of it long positions. Bitcoin is still trading as a high beta liquidity proxy, not digital gold. 65,000 is the line in the sand. Part 3. The Unwind signal. First, the wrapper risk. A Bitcoin treasury company is a levered, dividend-burdened wrapper around a coin you could hold directly. Up, the leverage is a feature; down, a liability. Second, reflexivity. The flywheel runs in reverse just as hard. Coin down, premium gone, can't issue, must sell coin. Third, the migration. Gold's reserve crown and the treasury unwind are one story. Capital wants the unencumbered store of value, not the engineering version of it. What we are watching this week: any further filing disclosing Bitcoin sales and Bitcoin versus 65,000, whether the fund outflow streak breaks, the SpaceX listing on June 12th, a real read on issuance appetite, the tariff comment period, the Iran and Hormuz path, and whether gold holds the 44 to 4,500 zone. And we keep score in public. Strategy: avoid the proxy, own the asset, not the lever. Gold, constructive on the reserve bid. Bitcoin, constructive but entry sensitive. Alphabet, quality and patient. Cigna, attractive. EQT, constructive. Eaton, watchlist at a full price. Coinbase, watchlist, high risk. These are dated, falsifiable calls, and we grade them. So where does it land? 1. A forced seller is a mechanism, not a headline. Watch the next filing, not the next tweet. 2. Own the asset, not the lever on it. Gold took the reserve crown the same week the leveraged treasury trade started unwinding. 3. The edge is unchanged, uncrowded, cash generative, unlevered, plus dry powder. Late cycle, the edge is the least overpaid quality, the unlevered store of value, and the discipline to let the forced sellers sell. That's the unwind. The asymmetric turns filings, flows, and market data into one disciplined read for investors who want the evidence, not the noise. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.